Hello and welcome to the KE Report. Chad and Corey here, getting an update from AbraSilver. AbraSilver is traded on the TSX.V under the ticker ABRA and on the OTC markets under the ticker ABBRF. We are talking today with John Miniotis, President and CEO of AbraSilver. And John, you got big news out, and that is the pre-feasibility study has come out. You released this just yesterday, and this is on the whole Diablillos project. And a lot of people have been looking back and forth between the prior economic study and this PFS study. Could you break down to us the key takeaways, the key metric changes between the studies? What's happened now as you've updated the project?
Perfect. Yeah, thanks very much for having me back on. As you mentioned, look, the pre-feasibility study that we just announced is definitely a very, very big milestone for the company. Overall, we're extremely pleased with the results, and I think it truly shows. I mean, it displays that Diablillos really has all the hallmarks now of being a world-class primary silver project. And so with the pre-feasibility study, I guess one of the key differences, I mean, the PA study was done over 2.5 years ago. Of course, it's a preliminary study. So it's based on resources at the time. We had based it almost entirely on measured and indicated resources. Whereas for PEA, you're allowed to incorporate inferred resources, which are even, more uncertain. So our PEA study was based on the measured and indicated resource base at that time, assumed a 7,000 ton per day plant, and had, very robust rates of return. And so the end net present value at that time, the base case, I believe, was about $475 million Canadian. Now, 2.5 years later, we've certainly drilled off this new Jack zone, much higher grade zone. And then overall, we've converted all of the measured and indicated resources into proven and probable reserves. And so now we're sitting on a reserve base of about 210 million ounces of silver equivalent, entirely based within the Oculto pit and starting off at the Jack pit, the new Jack deposit as well. And so now we have two deposits here. We increased the plant throughput to 9,000 tons per day instead of 7,000 tons per day, just given the overall increase in the resource base. And then once again, I mean, now with a higher level of confidence, you're basing this only on reserves. Your capital costs, your operating costs are estimated with a lot more detail for a pre-feas versus a PEA. We've incorporated all of the inflationary pressures that we've seen in the industry over the last several years, and have basically rerun the economics here. And yeah, extremely pleased. I mean, we come out with a base case net present value here of about $500 million US. That's using a 5% discount rate. Even at an 8% discount rate, which we show in table 1 there, it's over 360 million US net present value. And so a 25% after-tax rate of return, very quick payback period, long mine life, excellent production in terms of scale, and very, very low cash costs. So again, all the hallmarks here that you want to see. I think we check off all the boxes. We have a large-scale deposit with, again, significant exploration upside potential, which is not even being factored into the study at this time.
So, John, a lot of the recent news that we had talked about was that Jack zone, the higher grades that you're seeing there, the aggressive drill programs that you had to bring that up to the resource categories needed to include it in these economic studies. What more potential do we have at Jack or any of the other, as you said, exploration areas that could further improve the overall grade, the overall economics of this asset?
Sure. So yeah, the importance of Jack is clearly displayed in this pre-feasibility study. So when you look at the production profile, and again, that was one of the figures there in the press release. I believe it was figure 1. You can see during the first 5 years, there's significant elevated grades here. And so the average grade over the first 5 years here, because of this high grade Jack zone, is now averaging 210 grams per ton on a silver equivalent basis. And so if you use a quick 70-to-1 silver to gold sort of historical ratio there, the math is really easy. I mean, that equals to 3 grams per ton of gold, open pittable in oxides over 5 years. And so that really, really stands out. I mean, extremely high grades for oxide project sitting close to surface. And that's what enabled the production profile to average, again, about 18 million ounces a year here over that first 5-year period. And I think, in fact, the peak production in year 5 was 20 million ounces a year of silver equivalent. And so Jack was hugely important. It's only, 5 million tons of resource, but the grade, the elevated grade profile there has really helped boost the grades and as a result, the production in the early years. And certainly we have a number of other targets where we believe display similar characteristics, whether it's the Phantasma Zone, the Jack North, Alpaca. We have a lot of these targets that are identified that we expect to be drilling later on this year. Again, looking for a couple million tons in each of those. But if they have higher grades, then those come in early on in the mine plan and could lead to elevated production levels, elevated free cash flow right up front. So could certainly have very significant impact to your net present value and your economics here.
Yeah, John, it's going to be exciting to see what you find further at Jack North, at Alpaca, at Phantasma, some of these other targets, because if they could move up in the mine plan, they could juice up the economics on the front end and even possibly extend the mine life because you'd have more mine life at Oculto later on in the mine life process. The other thing that people are looking at here, John, is the mix of metals. You have, I think, about 60% silver, about 40% gold. Are there any options to potentially stream some of the gold as part of the capital stack to get this project built? Or what optionality do you have with the mix of the gold and the silver?
Yeah, there's certainly a lot of optionality. Having 100% precious metals gives you optionality. If you want to focus more on the silver, for sure, you could stream some of that gold to help fund the initial financing costs here of construction, or vice versa. If you're more focused on gold, you can for sure stream some of the silver. I mean, we like having that optionality. We're not looking to do any streams anytime soon. And so that's not something we're considering right now. But when you look at the production profile here, again, over the first 5 years, you're producing very, very high grades of silver from that Jack zone and from that high grade Tesoro zone within the Oculto pit. Those really come on between years 1 through 5. But then in the second half of the mine plan, you're getting deeper down into the Oculto pit, and you've already mined out Jack. So you're getting into that deep gold zone at Oculto, and it really transforms into a gold project at that time. So between year 6 and essentially 12 or year 13, the average gold production here is about 100,000 ounces of gold with another 3.5 million ounces of silver on top of that. So the project's pretty unique. It's a primary silver project up front, and then by midway through the mine life, transforms into a primary gold project with good silver byproduct credits. So it's excellent to have that flexibility. Again, it makes it more attractive to both silver and gold producers, gives you a lot of optionality in terms of potential streams, ways you can finance and build this out. And so, yeah, it's really great having that optionality for sure, being both silver rich and then towards the back half of the mine plan with gold grades above 1 gram per ton of gold. It's great having that flexibility here.
John, let's talk capital costs then, because the capital costs in this most recent study, just over 370 million US. That's initial capex, sustaining capital costs, about 65 million. You mentioned how it's a bigger production profile now, but we also know that inflation has obviously brought up some of those costs. What are you looking at when it comes to not just controlling costs here, but also balancing out that larger production profile while trying to keep costs somewhat restrained?
Yeah, a lot of work went into the capital cost estimates there. And so this is a very, very detailed summary. When you look at the capital cost spreadsheet that we have feeding these figures, it was literally over 9,000 rows. I mean, every single line item was estimated there. So the pre-feasibility study, a lot more work goes into the capital cost estimates, the operating cost assumptions compared to your PA. For a PA, you can essentially do some benchmarking and look at other open pit operations on a cost per ton, get a couple quotes, etc., and come out with a high level estimate. For this pre-feasibility study, over 80% of the items of those 9,000 rows, over 80% of the total capital costs there were based on actual contractor quotations. So it's very, very real figures. You're not benchmarking, you're not estimating. I mean, you're basing this on actual quotations. And obviously, those reflect reality. Those reflect all of the inflationary pressures, et cetera. And so, yeah, $373 million, where we're, very content with that estimate. We think that's very, very financeable project for a project of this scale and this quality. Diablillos, we feel without question, is going to be built. It's going to become a large-scale producing mine here, and still a relatively very reasonable capital cost, I think, for a project of this size. And we're very happy with all the detail that went into that estimate on our end.
Well, John, I'm going to ask you another question about how you're positioned in the marketplace as far as development stage projects here. And I would like you to just compare this project to other silver gold projects that would be open pit. How does the grade stack up? How does the all-in sustaining cost stack up? How does this compare to other similar projects in the sector?
Yeah, there's a lot more comparables on the gold side, to be honest. So gold, open pit, oxides, there's, dozens and dozens of those projects in the Americas. In terms of silver, I'd say there's very few open pitable silver projects out there. There's one of our peers, which is larger, has a much, much larger resource than us, but, literally a fraction of the grades. And so, I think when you look at this from an open pitable silver production level, there's very few comps. This is without question, I'd say, by far the highest grade open pitable silver project that I know of with oxides. But yeah, on the gold side as well, there are, like I said, dozens of comparables there. So there's a lot more companies to benchmark yourself against. And once again, our grades really stand out. So when you look at the M&I resource grades, we averaged 1.9 grams per ton gold equivalent. What's impressive is that now that we've declared a reserve, the grade profile actually increased. So your tonnage went down, but your grades actually increased. So our reserves are very close to 2 grams per ton on a gold basis. And when you benchmark that to other gold open pitable oxide projects, they range between, you can get 0.5 grams if you're heap leaching, but if you're running it through a leach processing plant like we are, typically it's 1 to 1.5 grams would be considered high grade for sure. But for our Jack zone, because the grades, as I mentioned, are 210 grams per ton, that equates to 3 grams per ton on a gold basis. And so that's off the charts. I haven't seen any other gold projects with 3 grams per ton in oxides, open pitable in the Americas at this stage. And so, I think the grade really stands out. The size of this deposit really stands out. I think on the silver production side, based on the numbers we just put out, that would rank Diablillos as a top 10 primary silver producer in the world. So this would be one of the top 10 largest silver producing assets out there. And again, very high grades, and it's close to surface, open pitable. So relatively manageable capex here. So we really think there's a scarcity premium, that deserves to be had here at Diablillos. But, obviously a lot of work ahead of us to continue to grow this resource and de-risk it and deliver a bankable feasibility study by the end of next year.
Another aspect that I would like a bit more information on here, John, deals with permitting. A lot of companies are going through permitting right now. And hey, look, if you're looking to bring this, or anybody's looking to bring this into more of a construction decision, what permits are needed? Where does the company stand broadly on this project?
Yeah, we're very well advanced on that side as well. And so the environmental impact assessment is your main overarching permit. We've been working on that for literally a year now. And so it's very, very well advanced. We've needed to wait until the pre-feasibility study is completed so we can incorporate all of those aspects into the economic impact assessment. Now that the pre-feas is obviously completed, we believe next quarter we could be submitting sometime in Q2 of this year. So before June 30th, we could be submitting the EIA to the provincial authorities there. And then in Salta, there's a very quick, relatively quick permitting process. It's a streamlined process. And so we expect that we could have permits in place here before the end of 2025. So that's really the goal, is by the end of 2025 to deliver a bankable feasibility study and have the EIA approval process in hand, which is your key permit. And then, of course, you need some other permits for construction, etc. But you have your overarching permit, you have your bankable feasibility study in place, and then pending a financing decision, this could be a construction-ready project at that time.
Well, John, you mentioned Salta, the province in Argentina, and I would love you to spend just a quick minute or two and just describe for people why that's a good jurisdiction, but also all of the other activity from other mining companies in the area. The reason I ask is because I think a lot of people hear Argentina, wrinkle their nose up. Maybe they're not aware of the recent political change there, but they're probably not aware of how Salta stacks up as far as a jurisdiction for mining.
So when you look at the Fraser Institute mining survey, they produce an annual survey every year, and they rank all jurisdictions globally. And so when they rank Latin America, for Argentina and specifically, I mean, for Latin American countries, they'll rank Chile and Mexico and Peru and Ecuador and Bolivia, all these countries. But for Argentina, they break it down by province. So then they'll rank Salta, they'll rank San Juan, they'll rank Santa Cruz. So all these provinces. And that's because there's a big dispersion. I mean, Argentina has very favorable mining jurisdictions, Salta being one, San Juan being the other, always consistently ranking very high on the Fraser Institute survey. But then you have other provinces where it's very, very difficult to permit and advance exploration projects. And so, yeah, in Argentina, Salta's booming as the mining capital of Argentina, I would say. And so we're surrounded by lithium projects being built, billions of dollars are being poured into those lithium projects, which are literally, within a 20-kilometer, 30-kilometer radius of us. You have Rio Tinto, you have Barrick, you have AngloGold, First Quantum, Fortuna, a whole bunch of large-scale companies in Salta with offices in Salta, looking for opportunities, advancing projects. And so Salta's always been known within Argentina as being very, very favorable to mining. Again, they have a quick permitting process. It's streamlined, and so very much encouraging mining investment in Salta. And so it's critical. If you're looking in mining in Argentina, you need to know which province you're in. I'd say Salta and San Juan are always seen as likely being the two best provinces within the country. There are several other very good, pro-mining provinces in Argentina. But yeah, we're very pleased. Diablillos is sitting in Salta on the border with Catamarca as well, which is another very good province. So no issues that we see there. We're in a mining jurisdiction. All the infrastructure is in place. We're surrounded by mines, and the communities are very much in favor of mining here.
All right, John, well, we'll wrap it up there, but it was great to get the overview of the pre-feasibility study from you and break down the different metrics and some of the key areas and takeaways for investors. For investors that want to get more information and see the news, definitely click on the link below this interview. It takes you right over to the AbraSilver website where you can see that news release for yourself. John, keep us posted as more news comes out later in the year, and we'll definitely be having you back on the show. And always appreciate having you on the KE Report. Looking forward to our next conversation.
Thanks very much.